Swayam Prabha. Digital India. Educated India.
Hello viewers, welcome to lecture number 7 on the blockchain series. In this lecture we will look at the scenario of blockchain in India. As with every other part of the world, blockchain has created a huge buzz in India also. It has created a huge buzz in the private sector, especially in the financial sector. It also has created a huge buzz in the government circles and NGOs and policy circles also. In fact, governments are individual state governments are looking at it as a really big initiative. They have a lot of initiatives to implement blockchains, and recently one state announced a complete blockchain policy. The objective is to attract blockchain companies to its creating a blockchain district where it is offering various incentives so that an ecosystem for blockchain is created in that location, in that city, and this government has announced a set of policy initiatives like giving them a break on rent and making land available, making power available, and various other kinds of incentives. So, a lot of initiatives are in motion. Let us take a look at some of them. Predominantly in this lecture I am going to focus on the finance and banking industry, because that is the area in which it has created as the maximum applicability, not just in terms of making the businesses faster and more efficient and more profitable, also from the angle of inclusivity and things like that. So, from that angle many initiatives have started for quite some time back. Some of these initiatives in terms of governance and other issues have been coming to the fore recently, but fintech related initiatives have been going on for quite some time. Even RBI has been publishing, it has been publishing policy documents, and recently it published a Sandbox. So, we will take a look at that aspect today. So, the scenario in India, blockchain is seen as an integral part of the financial technology platforms. It is seen as an integral part of fintech. In fact, there are Indian companies which are developing blockchains and blockchain based organizations, businesses meant for the global market. For example, there are many companies which are coming up with a P2P cryptocurrency banks, cryptocurrency lending and borrowing banks. As we can see, since cryptocurrencies are not really allowed in India, their main target market is other countries. So, companies are also looking at blockchains based in India from an international perspective. So, it is seen as an integral part of financial technology platforms or fintech. Blockchain based applications are particularly suitable for banks, and as we will see, RBI has been taking the lead. RBI has associated organizations like IDRBT, Institute of Development and Research in Banking Technology, and NPCI in Hyderabad, NPCI National Payment Council of India. These are RBI associated organizations. All of them are at the forefront of adoption of blockchain in India, which gives us a sense of how important it is considered in government and policy circles. So, this is from a document published by a private company in terms of potential area of application of blockchain into banks. So, at heart, blockchain is a chronological, in time order, immutable, unchanging ledger. What does it provide? It provides transparency, which we have seen. Transparently it has established trust. It provides efficiency, transactions happen quickly, intermediaries are removed, transactions happen directly from person to person, much faster, much cheaper. No trusted parties are required, which again adds to efficiency and cost, provides excellent security based on cryptography and various other tools. And this is the core of blockchain, heart of blockchain. What are the additional aspects of blockchain which are built on top of it? One, obviously, as we have seen, is smart contracts, which link blockchain into legally enforcing actions. Data storage, how is data stored? To make it more performance oriented, to make it safer against loss, damage, and loss of integrity. They can be used for digital content, you can use blockchain for digital identity, or they leverage digital identity. The certificate I present, using my private and public key, is my digital identity, and blockchains do use that to establish identity. Blockchains can also be used, and they also do document storage and delivery. Blockchains can be done on the smartphone in the form of a smartphone application. One more emerging field of technology called Internet of Things can be linked to blockchain. For example, that once we have a widespread availability of Internet of Things, when somebody delivers a pizza, I do not have to sign it also. The moment that man enters my home and puts that thing down on the table, gets recorded theoretically. So, that can be linked to blockchain. And authentication, which is directly linked with digital identity. Blockchains use various forms of authentication. Once my authentication is stored on a blockchain, I can also use it to prove my authentication to a third party. So, in this, who are the various fields, realms of business who can leverage this, who are going to be significantly and profoundly affected by the effect of this technology, who should be able to adopt this and make their businesses more robust, safe, secure, profitable, all that. One is obviously travel and transportation. We can use it for loyalty points, booking records, entire history. All the tickets I have bought from a particular airline, all the points I have gathered can be stored in one point. I can go and verify that. Retail manufacturing, e-commerce, marketplace, home automation. E-commerce is heavily on the internet already, and big chunks of their business is already transparent to us. To induce buying, for example, many companies announce how many items they have in stock already, so that if they have less items in stock, you are induced to buy it quickly. Technology and media, again another huge usage of blockchains, especially when associated with cryptocurrency. For example, micropayments are ideally suited for distributing media products. I just don't want a movie. The whole movie may cost me $20. I just want one song from that, which costs half $1 or 25 cents. And that kind of a transaction in the current transaction based world using ERP or various systems, simply not worth it. The cost of transaction is high enough to not. So, either they would like it to sell you the whole movie for $25, not necessarily one song, but I want only that particular song. Whereas blockchain in association with cryptocurrency supports micropayments, which is ideal. Remember, a Bitcoin can be divided into 100 million parts. So, even that transaction of 100 millionth of a Bitcoin is still possible because of the very low transaction costs. So, which is ideal for technology and media to disseminate their products, keep track of what has been sold to whom, protect their intellectual property, and sell us information in the minutest chunks. I do not need an annual subscription for the Wall Street Journal. I pay for only those articles that I download. And finally, we come to banking, the subject of this lecture. So, in banking and financial securities and insurance fields, blockchains can be used for foreign settlements in general. What happens on a day, banks do a lot of transaction between each other. One bank borrows from the other, lends to other, they lend for somebody else's customers. Like Bank of Baroda may lend money to SBI's customers. They at midnight they square up all these accounts. Every day, typically once a day, they square up. They tally everything and decide who has to pay whom and how much. If they do not pay, if they pay next day, how much interest has to be paid. This process is called settlement, and this definitely it happens both at the national level, it happens at the international level, and at the international level, it happens in the form of foreign currency settlements. So, blockchains are ideally suited to do those transactions. Especially these are trusted parties. So, we do not need, even trust may not be that big a factor. Cross border payments, trade finance. Trade finance is in the form of, there is something called a letter of credit. I will explain this a little later in the same session when we talk about the pilot project done. And OTC derivative contract, what are called over the counter derivative contract, a type of security contracts indulged by certain parties, where time and cost is of essence, and blockchains provide both. So, banks not just in India, everywhere are the organizations which are looking very closely at blockchain. In the very first talk, I talked about amount of venture capital, amount of startups in various areas, very clearly the finance and banking sector was the dominant part of that. Maximum number of startups are coming in that sector, maximum amount of venture capital also is going into that sector. What are the various areas of banking? The previous one gave some rough idea. This slide gives that in much more detail. Trade finance, that is, when organizations, countries trade with each other, it has to be financed. Trade typically, especially international trade, takes time. By the time somebody gives an order to me, let us say I am exporting to US, if by the time somebody gives me an order, I have to ship that item, assuming it is for a material item like apparels or anything like that. I have to make, I may have to manufacture or assemble that product, pack it, ship it to the nearest port or the nearest airport. If it is even in case of an airline, it may take 2 to 3 days to reach the US. In case of shipping, it may take up to 2 weeks for it to go there. It has to get unloaded, clear customs on the other side, reaches the customer there, and only then the customer will pay me. So, this process has to be financed, this whole chain, somebody has to finance it. By the time I send the item, by the time I get the actual payment, some intermediaries are required to make sure that the financing happens smoothly and clearly. This whole set of activities is generally referred to as trade finance. Under that, the various activities include letter of credit, amendment, realization and advice, one set of activities, bank guarantee, one more tool to ensure smooth payment of smooth flow of payments between two non-trusting parties, issuance of bank guarantee and amendments. These are the activities which are ideally suited for putting it on the blockchain. In terms of reporting, consumer reporting, for example, every credit card company has to report all the transactions of a consumer on a monthly basis. Every month they have to send me how much I have spent on various purchases, how much I paid last time, how much do I have to pay this month, what is the minimum payment, what is the total payment, so that I make the payment on time or defer it. And if I want to dispute any charge, I can look at the list and say this is a charge I am disputing. Or banks have to, those who maintain a banking account, whether savings or current, every month they have to give you a statements. What are the debits to your account, what are the credits to your account, what are the charges against your account. This is done on a mass scale. So, instead of sending you a physical mailer, many companies have shifted to e-form where they still email you with the document. If I can put it on a blockchain, they may not even have to do that. I can go and see it for myself. Some of the online banks are providing that feature. This can be done much more smoothly using a blockchain. And inquiry. If I want to know how did this particular charge happen on my account, I have to call somebody. Even if I download the statement, that explanation may not be there. There will be some cryptic ABFC, HD, FHDFC 1335, 3555 SB. Some cryptic announcement will be there next to that entry. I will have to call the technical the customer support. Now, that explanation can be added to a blockchain. If this whole transaction is on a blockchain, an explanation can be attached to that, saying that this was an online transfer from my account to somebody's account in SBI on such and such a date with my explanation too. And regulatory reporting. Other than customers, banks also have to constantly send regular reports to various agencies starting with RBI. Every so often they have to send a series of reports to RBI. All these things, instead of somebody preparing and making it, they can make it available 24/7, 365 days to any regulatory authority by putting it on a blockchain. Document management. Again, once you put it on a blockchain, it is made available, it can be safely made available to anyone. We do not have to call them. If I want to read a printout of a old statement, or if I want a really old statement, most banks let me get my statements for the past 12 months. Anything beyond that, I will either have to put a request over the phone or request by the or by email, or in some cases I may have to go to the manager itself, go to the bank branch, meet the manager. By putting a blockchain, we can also put various kinds of constraints and various authentication. Once I prove that I am this customer and I want these documents, they can be made available right there because it is stored on the blockchain. In terms of treasury operations and security, various activities like e-bonds, equity, bonds, treasury bills. Treasury bills are bonds floated by the government, foreign deal contracts, put, call, money market, these are all financial terms. Those of you who are from the financial world are studying finance will understand this. Others who are interested can go and refer to them. All these activities are time and cost consuming, they also need storage, they have to be done fast. Solution, blockchain. Trading, clearing, settlement, buying stocks, buying shares, buying them on the margin, paying for them, settling them, selling and settling all the accounts at the end of the settlement period. Safely, it is done right now, could be done on blockchain. Trade valuation, credit monitoring, position management, all these activities essentially they need two parties to trust each other, but one trusted party puts all the information out, other party should be able to safely retrieve that information. The party which is putting the information needs to make sure that the confidentiality and integrity of that information is protected, so that only those parties who are eligible to look at their information are allowed to look at their information. Maybe they are not allowed to modify anything. The trusted party has to make sure that the confidentiality and integrity of the information is protected at the lowest cost. Today a lot of money is spent in ensuring these two aspects of any financial information, also extend to health information and things like that. How can we do it much faster and much cheaper? By using a blockchain. Payments, again another huge industry, mobile payments, e-commerce payments, point of sale transactions, ATM transactions, cash concentration and notional pooling. All these activities are currently done, they can be done cheaper, faster by blockchains. Capital management and fund management, settlement of security, dividend payout, shareholder management, share registry, superannuation. For example, due to whatever reason company has sent you a dividend certificate, you are not able to encash that. So, how do you go back to the company and say, look, I forgot my dividend from 2011, can you send it back to me? If the whole information on a blockchain, I can take that relevant piece of information, show it to them. I can show it to them that you issued a check to me in 2011, I searched the whole blockchain, there is no record of this check has been encashed. That is how it is much easier. Today I have to give an undertaking saying that I have not encashed the check, I have to send so many pieces of information. If this dividend payout is maintained on the blockchain, you just have to go to the blockchain, quickly verify that the check was issued on this date, not been encashed so far. So, all these processes are done much faster, with much effort. Managing loan, this is one big area where blockchain is making a big difference in banks. It is still at a concept level, not become very prevalent, but already organizations or companies have come up with person to person lending, P2P lending. That is, I have 10,000 rupees in my account lying idle, or I have 1 Bitcoin lying in my account lying idle, somebody else another 20,000, 50,000, and another party on the other side has 1 lakh, he wants to borrow 1 lakh and he has some currency, it could be actual currency, it could be Ether, it could be Ripple, he wants to give that as a collateral. So, how do we bring these two parties together? 8 of us can pool here, put together 1 lakh, take his cryptocurrency as a security, lend him cash 1 lakh. And these are all small numbers which may not be attractive for a traditional financial institution, traditional loan institution, traditional bank, but blockchain makes such a thing possible. So, there are banks coming up to enable P2P lending, person to person lending, and some of the biggest players in this field are already doing transactions worth a few $1 billion per year. So, potential is considered to be huge. Provide managing corporate loans and retail loans, managing mortgages, all these things can be put on the blockchain. As you can see from this brief picture, that pretty much any aspect of banking can be profitably put on the blockchain. It is a different aspect whether regulatory authorities allow that or not, but the potential to put them on blockchain to leverage the benefits of blockchain is very enormous. That is one reason why all financial institutions, the whole financial technology industry is seriously looking at blockchain. Today, if you are talking about fintech, we must talk about blockchain. It is an integral part of fintech, has so many components to that. blockchain today has become in a very short period, fintech has become a very critical component of fintech. So, towards this, realizing the potential for the enormous applications of blockchain in the financial industry, but at the same time being aware that, for example, let us go back, the person to person lending. Person to person lending, we do not know anybody else, there is person, I do not know anyone, there is no intermediate authority. So, how do we ensure that restitution if something goes wrong? Where do we go? Where do we go for getting a problem solved? Or for example, for a hypothetical example, let us take that 5 of us have pulled together to lend 1 lakh to another party whose collateral is something we have not heard of, some coin, some cyber coin, and this particular coin had a particular value that day. Let us say on that day its value was 2 lakhs. So, we are taking collateral of 2 lakhs to give a loan of 1 lakh. That is how typically banks work, right? Perfectly fine. But due to some reason, maybe that blockchain was hacked, it crashed, or this gentleman lost the keys for the currency, the value of collateral goes down to 0. So, the effects of what can happen is unpredictable. We right now do not know. So, the risks have not been, cannot be quantified so easily because we are still, the field is still evolving. So, mindful of the fact that while the benefits it brings to the table are enormous, they can reduce the cost, they can make it cheaper. More importantly, one of the key elements in India is inclusion. It is pretty well known that while smartphones and other technology components are very widespread, most people do have high penetration, high bandwidth, we are still a very seriously underbanked country. The banking only now, thanks to Jan Dhan project, many more people have been provided bank accounts. Even there we keep hearing anecdotal stories, as for example, when some of these subsidies are transferred to their account, they have to spend almost a day traveling to the nearest big town, the taluk center, to the bank branch to withdraw money. So, inclusion is a big issue in India. Cost. So, if you have to travel almost a day to the branch, I have to spend money, whatever benefit, the subsidy I am getting, I am losing some of it. So, how do we make it more inclusive? More, same thing about insurance. Many of the poorer segments do not have insurance. How do we pull them together? We can do them using blockchain, but what are the consequences? How does it work? What are the unintended effects? What are the things that we have not foreseen? These are some of the big challenges in technology. When technology spreads out in the world, it is very difficult to classify both the benefits and the risk in advance. Only when it gets widely adopted will we become more familiar, more comfortable with risks and benefits. But unfortunately, unless we try these things in the field, it may not be possible to find out these risks and benefits. So, with that in view, recently RBI has published a draft enabling framework for regulatory sandbox to enable innovation in fintech. All these are innovations in fintech. We do not know what the risks are. We have some rough idea of benefits, we have some rough idea of risks. What are the true benefits? What are the true risks? We will only know when we actually try them out in the field with actual customers. So, for that it may not be feasible or not be advisable to do it just like that. So, let us try them in a very controlled environment. It is called a sandbox. In the next few slides we will see what a sandbox is, and it is called a financial sandbox, which is applied to, if it is applied to the financial industry. The Reserve Bank, always on the forefront, has come up with a draft policy saying that we are going to create a sandbox. These are the things you can do, these are things you cannot do, this is how it works. So, it is a very proactive move on part of the RBI. Let us take a more detailed look at sandbox for fintech, and before that let us see what is a sandbox. Based on what I have said, I hope all of you are already convinced now that in order to get the true benefit of technology in a safe manner, we first need to try them out. For that, we need to try them out in a test environment. If any of you have worked in the IT field, in the corporate world, whenever we develop any application, say I develop this new banking application, I simply do not develop and put it out on the web or on the server for everybody to use. We typically test it by the people who have developed it, one level of testing. When we put it in a test environment, where a number of non-developers, people who are supposed to use it, test the whole system thoroughly. It is sometimes called user acceptance test. Then we have technical people who test it for performance. They load this environment with transactions to make sure while testing, while developing, 10 people might have tested the system. When we put it in actual practice, 5,000 people may come on the system, 20,000 people come on the system. When they come to the system, can it handle all these users? How fast is its reaction? Are there bugs? Are there features which we have not seen? So, this is done in a testing environment. After that, many of them open it to a select set of customers, sometimes called a beta testing. Some select customers use from their perspective and find out, then and only then a system is rolled out for public usage. So, whenever we come up with new technology, new applications, we need a way to safely test them, and if it does not work, go back without much damage done. Only when we are convinced thoroughly that every kink has been ironed out, every bug has been removed, all the features are intended as they are to be intended, then we open up. So, to do this safely, and at the same time we need to encourage innovation, which will only happen when we are able to try it and find out. We need to be very quick. All these tests have to be done quickly, because if we do 2 years, take 2 years to test a system, somebody else would have done something else, which probably will undercut our entire technology. So, how do we do it safely? How do we do it quickly? And make sure that it does not affect the outside world. If the effects are negative, we need an environment to be able to do all these things. That is for that reason we need this sandbox. So, we will take a look at what a sandbox is. This is from a news article, an article in a newspaper which fairly covered the sandbox in fair detail. So, let us take a look at what they say. Let us take a test case for proving that we need a sandbox. Consider a firm that wants to launch a micro insurance product. Again, insurance is there on it is affordable only for the more affluent parts of society now. The idea is moving towards micro insurance. We do not pay 50,000 rupees per year, we pay 100 rupees per month for one person. It is a micro insurance. Most life insurance products for senior citizens today cost 50,000-60,000 rupees. Instead, we charge 100 rupees per month. So, it is a micro insurance product, purchasable using mobile airtime. How do we purchase insurance today? And either we go on the web, or an insurance agent comes to our home, makes us fill all the documents, gets us the policy. Instead, this, which is an expensive affair, it costs time and money for that insurance agent to come to our home, spend time with us, explain everything, get it done. Here it is purchasable using mobile. I can go to the mobile and use an app, buy the insurance online. The firm, to do this, to be able to sell insurance on a micro form over the mobile, the firm will collaborate with telecom players for distribution. Various telecom players, Vodafone, Airtel, Idea, they have to make that app available on their platforms, and with insurance providers for underwriting risk. All insurance involves a risk, we need to reinsure them. So, my company simply distributes this micro insurance, I need to insure them actually with the insurance company. It believes, this company, this product can be a game changer for India, which had near 100% tele density. That means almost everybody has a telephone, but less than 15% life insurance penetration as of 2015. These numbers have slight changed because of Jan Ayush program and various programs, but still numbers are nowhere near what it is in the advanced countries. However, the firm will require regulatory clarity. Today, policy is not clear whether insurance can be sold by an app or the smartphone. Even when they have advertisements on the radio, for example, you must have heard them putting various disclaimers at the end, saying that insurance cannot be sold over the phone, or it cannot be solicitation is not allowed for insurance, various things. So, do we know what do the regulations say whether insurance can be sold over the smartphone by an app? So, that is not clear. The regulatory clarity is not clear, since its product will attract the purview of multiple regulators. For example, to sell this micro insurance, you may need permission from the Insurance Regulatory and Development Authority, IRDA, the Telecom Regulatory Authority of India, and possibly Reserve Bank of India. Insurance Regulatory Development Authority because it is insurance, so we need their approval. Is it the right kind of insurance? Does it meet the standards? Telecom Authority because it is sold over the phone by an app. Is it allowed today? They have to clarify. And since it is a matter of money, ultimately RBI will also have a say. What can we offer in return? But the regulators are unable to accurately assess the risks associated with such a new product, and regulatory coordination is limited. So, if we go and ask IRDA for example, what is your policy on selling insurance over the telecom or the telephone? They may not have interacted with the telecom regulatory authority to give an answer. They may say go and talk to them. You go and talk to TRA, they may say we do not know about insurance, we do not allow, go talk to IRDA. So, given the limited coordination, and secondly each one of them may not have assessed the impact of doing this, there is no clarity. So, as a result the firm will have to abort the launch due to regulatory ambiguity. We do not know what the regulations say. So, even though we start with good intentions to introduce this product, we may not be able to introduce this product because one, it may not be allowed, we do not know whether it is allowed or not. Number two, if it fails for whatever reason, if there is any negative effect, we do not know what the consequences are, we do not know what the liabilities we are carrying, we do not know who can sue us. That is the current state of selling insurance over the smartphone. This is the reason why we need a regulatory sandbox. A regulatory sandbox, what is it? It is an entity, it is an organization hosted or endorsed by the regulators, like all three can come together, the Telecom Regulatory Authority, IRDA and RBI, and say we will give you this set of servers, these are the policies applicable, try it out. All three of us know what you are doing, we have come to an agreement endorsed by the regulators that enables temporary limited scale testing. Put your system, sell your insurance for 3 months, let us see what happens. Temporary limited scale in this particular area of a new product that may involve some regulatory ambiguity or temporarily relax a regulatory requirement. Right now maybe the rules are that you can't sell insurance over the phone. So, the Telecom Regulatory Authority will relax that and say for this 3 months in this area on this server you can sell it over the phone. To enable such a product to launch, to assess the potential benefits and the risks posed by such a move, to again to go back, relax the regulatory requirement to enable such a product to launch, to assess the potential benefit and risks posed by such a move to consumers of the market. It is a well known fact that any innovation get adopted by trial and error. We have to try, we have to test in the field, we have to test in the lab, we have to test in the field. So, this is a lab environment where we can test within given constraints, but gives us a realistic picture of what the benefits are, what the risks are. To come back to the case study shown in the micro insurance case, the regulators could ask the firm to test their product in a sandbox setting for a limited period, say 3 months, and on a restricted scale, say 10,000 customers. You put this on the set of servers for 3 months, sell it to 10,000 customers, let us see how it works, accept the premiums from them, provide the settlements, benefits whenever they need, while laying out metrics for evaluation. So, at the end of 3 months we should be able to say, is this experiment a success, was it a beneficial product, is it better than what we have on today. So, at the end of 3 months we must be able to say, out of 10,000 there are 3,500 claims, they were settled within this period and this is satisfactory. We have to have some metrics to say, we have to some numbers to say that if we run it for 3 months, if there are 3,000 claims which are all settled within 24 hours, good experiments, go ahead. There are 3,000 claims, only half were paid. There were 3,000 claims, none of them were paid within a week, the shortest period taken was a week. So, if there are measures which do not meet our standards, then we could say we tried it, does not work safely. So, only 10,000 customers are affected, probably they can be compensated easily. While laying out metrics for evaluation, this would generate the evidence required to help regulators decide on the benefits. So, once we have these numbers, the evidence, we can say whether it is good or bad, whether we can go ahead. If we go ahead, do we need to make any modifications? Say the potential to increase insurance coverage. As well known, insurance coverage is not very widespread in India, but this experiment may help us do that. Vis-a-vis risk, say mis-selling. Is insurance sold? Was it sold correctly? We often see that a life insurance may have been sold as an investment, which is not the right way to resell that, but we have seen such practices in the field. So, was it sold the right way? If sold the right way, does it still give the benefits? Do customers still find it attractive? So, all these factors we can know and how best to regulate it. So, you can say only those phones registered with this particular thing are allowed to buy insurance, things like that, we have regulations. So, that is the concept of a regulatory sandbox as applicable to the financial industry. Very recently RBI has published the final draft. The original draft was published about a year and a half back. Now, it is being finalized after getting comments from various stakeholders and parties. So, let us take a more deeper look at that. And before we go there, these authors also have put down a set of requirements for a regulatory sandbox worthwhile knowing. First and foremost, it should be a single integrated sandbox serving all financial regulators. If a sandbox is set up, as in this case, there are three parties shown in the case study: the Telecom Regulatory Authority, Insurance Regulatory Authority IRDA and RBI. The sandbox should be set up by all three of them put together. Each party should know what is allowed in the sandbox, what is not allowed. They should agree to that, and a party which wants to try any new product does not have to get approval from all three. You get an approval for the sandbox, it is from all three together. There should be a single integrated sandbox serving all financial sector regulators. Second, it should be autonomous yet be embedded with the regulators. One example could be, to run this sandbox, you may need experts who are experts in blockchain. You may need experts who are experts in the cloud. They may not be working for any of these regulators. You may have to temporarily hire them on contract. You may have to outsource that activity to a company like Infosys. So, we should be able to bring in private parties, third parties. There may be an NGO which are experts in evaluating these experiments to find out whether they are developing the metrics for evaluation. We should be able to bring them into the picture temporarily if necessary, but at the same time embedded in the regulators. That means the rules and regulations they follow, what rules they can follow, what rules they do not need to follow, should be approved. It should be under the control of only the parties who are the regulatory authorities who are building the sandbox. That is the second requirement for a sandbox. Third, the role of the sandbox should only be to assist the regulator to help in decision making, not replace it. Just because an experiment or a product shows excellent results in the sandbox does not mean that they automatically get the approval to go and implement it in practice, sell it to the public. Still, the final decision, even after success in a sandbox, should be with the regulators. They should decide after looking at it, after considering other issues which may include factors such as social terms and conditions and social issues, political issues, various other issues. So, final authority may be dependent on those factors that should be in the hands of regulators. Just because an experiment succeeds in a sandbox should not mean an automatic entry into the business or commercial field. The sandbox should have robust systems to identify, quantify and monitor risks emerging from the new product. From a regulator's perspective, more than the benefits, it is the risks that are more critical. Benefits may be there, but if the risks are so high as to bring the whole systems down, may not be worth trying. So, all the regulatory authorities who are making the sandbox should be completely clear that if we do this, we should get a clear picture of what are the risks involved in the system. And finally, engagement process for industry should be business friendly. There is always a difference between business and government in the way they look at things, in the way they perform things, the speed with which perform things. Industry always typically is driven by competition, it is driven by what others are doing, it is driven by innovation. If this micro insurance product takes 1 year, 2 years to trusting, mainly because all these regulatory authorities took a lot of time to approve that, the pace of technology is so fast that there may be something happening somewhere else which may completely make my product redundant. So, That is why when we say business friendly, the government works at the speed of business, and there should be single source of, for example, having a single person to contact. Any problem in the government, I should not be made to go from one person to another. Oh me, oh we do not know that, go to that department. Oh, you go to that department and say, oh we do part of it, the third department does, which is in a different city. All these things are not necessarily business friendly. We need one source, everything very clear, no ambiguity, and there is one single source, which makes that experiment worthwhile, because doing an experiment in a sandbox also costs time and money for the organizations, for the businesses. So, sandbox should have, if it has these 5 features, it serves its purpose of being a lab where we can try new and new innovative ideas. So, RBI has recently published a draft enabling framework for a regulatory sandbox, and this is from the document itself, what RBI says about it. The regulatory sandbox provides an environment for innovative technology led entities for limited scale testing of a new product or service that may or may not involve some relaxation in a regulatory requirement before a wider scale launch. Pretty much what the previous author said in terms of what a sandbox is meant to be. A regulatory sandbox is an entity hosted or endorsed by the regulators, in this case RBI, that enables temporary limited scale testing and or temporarily relax a regulatory requirement to enable a product launch, assess the potential benefit and risk. RBI's definition pretty much matches that. To environment for innovative technology led entities for temporary limited scale testing of a new product or service that may or may not involve some relaxation. Rules may not be removed, they may be relaxed temporarily depending on case to case. We will again see what RBI says about it in a regulatory requirement before a wider scale launch. Some of the expected benefits. What are the benefits that RBI sees from this sandbox for the Indian financial industry? First, learn how new and innovative technologies work by implementing them in a limited way. There is no alternative to knowing something as testing it, as using it, as testing it in the real field, not in the lab. In lab we control conditions, nothing like testing it in the field. Contain the risk in trial implementation. If the product turns out to be very risky, by testing it in a limited scale, we are containing. Remember, we have 1.3 billion people who need insurance. In the case study done, that sandbox testing let it try on 10,000 people. So, if that experiment goes bad, a small number of people are 10,000 is still a big number compared to overall population, it is a limited number. More importantly, if it does go bad, the number is small enough that does not affect the big population and they can be compensated if necessary easily compared to doing it on a mass basis. Number 3, understand the changes in regulation that are needed for widespread adoption. For the microfinance example, if selling insurance on the smartphone is not allowed, we understand that for this experiment to succeed, it turns out to be very good. For that to succeed, we need to relax that regulation so that it can be sold by the app on a smartphone. Understand the cost benefit of new innovation. What is the cost of rolling out this product? What is the benefit that comes out of that? Test viability of innovation products. Is it viable at all? Yes, the microfinance thing is fairly cheap and it is useful, but people may not be comfortable. They want to see the information, they want to see the insurance agent. So, is it viable? It may be a good experiment, is it viable or not? It may not depend on the technology itself. So, testing the viability of an innovation product also is one of the benefits. Encourage innovations in financial inclusion and faster absorption. As I said, one of the big benefits that governments, especially in countries like India, are looking at blockchain is to bring inclusion, get everybody into the system. So, sandbox is a way of enabling innovations in inclusion. Provide regulators with a structured environment for evidence based decision making. If somebody gives me a description of the product and gives me these are the benefits they claim, I may not be able to believe it right away. Only when we do it on a sandbox, we have evidence also now. How does the evidence match with what they have claimed? If the benefits as happens on the sandbox match their claims, we know that is a good product. If the sandbox does not succeed, we have evidence not to approve the product. So, by sandbox we do not have to believe in words, we have actual evidence, we can make decisions based on that evidence. And finally, ultimate objective after doing all this is to provide customers with new products and services leading to reduced cost and better access to financial services. As always, provide inclusion, provide reduced cost, to provide customers with these are the benefits that RBI expects out of its sandbox. And more importantly, RBI has clearly said only these products and services are allowed under sandbox. If I do some innovation in the blockchain or in any of these areas, we have to go and look and see whether it comes under any of these. One is retail payments, typically something like Paytm and various other companies are doing, they can be tested. If you come up with an alternative to any of these payment methods in retail payments, those products can be tested under the sandbox. Money transfer services, historically we have used Telegram, today we have so many other ways of doing it, they can be tested. Marketplace lending, P2P lending for example, not in cryptocurrencies, in real currencies, marketplace lending. Digital KYC, instead of providing a set of documents, my photo, sign for KYC, can it be done digitally? Can I upload my photo? How do I attest that? Can I upload my Aadhaar number? Can I upload my biometrics to make sure it matches the Aadhaar? Digital KYC. Financial advisory services, wealth management services, they can be tested. Wealth managers are typically people who come and take your portfolio, all your savings, assets and all, they manage them to provide you with returns. I may be just letting my money sitting in an FD, somebody may come and offer to invest it on those funds on my behalf to generate a higher return than that and manage my overall wealth to give me better returns, and they take their fees along with that. Digital identification services linked to KYC, smart contracts, financial inclusion products, cyber security products, these are all the products and services which can be tested in the smart contracts. What are the technologies that can be tried? These are the products and services. The technologies that can be tried are allowed: mobile technology applications in terms of payments, digital identity, etc. Data analytics, I will not go into that, but it is a growing field as I mentioned. Application programming API services. For us, for this course, RBI allows applications under blockchain technology. The technology is blockchain. What is it used for? There is a restrict. What is the blockchain used for? If blockchain is being used for any of these services, permitted. RBI has a list of other services which are not permitted. We will come to that. So, all those products under blockchain, if blockchain is deployed for any of these products, RBI allows us to try that product on the RBI sandbox regulation. And finally, artificial intelligence and machine learning applications. If we are applying AI and machine learning for these products, if we have come up with a product or a service, we can test them out in real world using this sandbox. What are the products and technologies not included? It is a very specifically said, you cannot trust this. Credit registry, keeping track of people's credit history. Credit registry and credit information. Information and registry is where it is kept. Credit registry, as the name itself says, is very amenable to putting on the blockchain. So, if I come up with a company which maintains the credit registry using blockchain, we cannot test it out on the sandbox. Cryptocurrency and crypto asset services. So, all these crypto P2P lending banks which are coming out even within India or various countries, they cannot be tested in the sandbox because RBI itself does not allow cryptocurrencies. Trading, investing, settling in crypto assets, corollary to the one above. ICO, initial coin offerings, another huge area of interest in the cryptocurrency world and the blockchain world. They cannot be tested out in the blockchain. Chain marketing services, where I sell a product to you, you get 10 customers, sell those products to them, what are called pyramid marketing services, they are not allowed. And on top of it, any product services which have been banned by the regulators, governments of India. For example, hazardous materials, cannot be openly sold. They have to be regulated, you have to get the license approval and all. So, such things, such products cannot be tested out on the sandbox. So, RPI has clearly said what the sandbox will do, what are the benefits expected, what are the products which can be tested, what are the technologies that can be tested, what are the products and technologies that cannot be tested. All in all, an excellent initiative which will significantly help the development and innovation in the fintech industry. Any of you are in the financial field, you may want to look at the various commentary, lot of it has been commented upon a lot in the news media. You may want to take a look at what others are saying about it. Most of them have welcomed, but some also have had reservations, criticisms about the initiative. And lastly, about 2 years back, RBI through IDRBT, Institute of Development in Banking Research and Technology, they did a pilot project to see how best can we use blockchain within banking. What are the things we can use it? They conducted a small pilot study with about 8 public sector banks, and this is the architecture of the whole pilot study they set up. They actually set up a blockchain based on the Hyperledger platform. They got 8 banks which are the nodes, which are the stakeholders in the system. They conducted a set of transactions, tried out various transactions, came up with the results. Let us take a brief look at that. These are some of the specifications. Hardware for nodes validation, they had 8 core dedicated servers. Application servers had disk capacity 4G on cores, mainly information for those of you who are interested in the technology. The certificate authority server, they did not use an external authority server like VeriSign, they used something within the system. The operating system is Ubuntu. Those of you who are paying attention, you would probably recognize that Ubuntu is a variation of Linux. It is a variety of Linux provided by this company, which is available for free. So, IDRBT used that operating system for all their computers. The peers, the blockchain itself was developed using Hyperledger Fabric version 0.61. So, this is not a Ethereum based one, it is a Hyperledger based blockchain. And the application servers had this set of software including the Fabric node for the Hyperledger. It used Hyperledger Fabric and chain code. Again, if you are paying attention, chain code is a module added to Hyperledger to enable coins. Hyperledger does not include currency or tokens, chain code provides that. So, this blockchain they implemented was based on Hyperledger, but it also had currency using chain code. So, this is a more detailed picture, and one use case they have given in their pilot study. The white paper has been published on this, a very detailed white paper. One use case they have shown is for letter of credit. How letter of credit can change by applying blockchain with the leverage of blockchain. To recall, letter of credit is involved whenever we do any trading across the countries where the foreign exchange involved. Let us see how the flow happens. How does a normal letter of credit process happen? There are 5 parties here. There is a buyer, there is a seller, there is a buyer's bank, there is a seller's bank, there is a settling agency which approves all this. In this case, it is NPCI, National Payment Council of India. The buyer negotiates purchase order, submits letter of credit application to the bank. So, the buyer tells the seller that I want to buy so many items. Seller says, show me a letter of credit. Before I ship the item to you, show me that this is how you are going to pay me. So, the buyer, once we agree upon the price and quantity and all that, buyer negotiates that contract, takes it to the bank and say, give me a letter of credit. The bank, so the buyer's bank reviews the letter of credit. They have their constraints. This buyer, do we have a line of credit? Does he have enough assets? Do we have enough collateral? Based on various criteria, they review the request for letter of credit and approve it. They say the bank issues a letter of credit, which means the bank is guaranteeing that if the items are delivered by the seller to the buyer, the bank will take that amount of money from the ensure that that amount of money is transferred from buyer to the seller. And the buyer's bank, once it approves, issues a letter of credit, sends a copy of letter to the seller, more precisely their bank, and the bank will provide, the seller's bank will give a copy of the letter to the seller, or it can be independently give to them also. The seller looks at the letter of credit, terms and conditions. If they are acceptable, ships the goods, and it puts them all in proper containers, puts them out, and submits the shipping documents for payments. There are many varieties in which this is done. Some terms and conditions say the seller simply has to load the goods on the ship or on the rail, done, that means shipping is done. Many conditions say the seller has to deliver it, all the items to the port in the country of buyer. If I buy an item, I will only pay the seller when the items reach the Chennai port or Mumbai port or something. In many cases, the letter of credit may say the letter of credit will fire if the items are delivered to the location of the buyer. Different terms, but what the seller does is he puts them, delivers them, does the mechanism. Once it is done, whether it is to his port or ship or my port, gives the letter of credit to the buyer's bank. The buyer's bank reviews the shipping documents. It looks at the document and see, was it delivered to the ship, was it delivered on rail, was it delivered to the port at the buyer's country, and make sure that terms have been met and approves the payment. Once that payment has been approved, the settlement company, a payment bank in the buyer's country, NPCI in our case, it actually processes the payment. The bank takes the money and gives it to NPCI. NPCI takes it and it debits the buyer's account and send confirmation to the buyer. So, the payment authority, payment agency, the clearing agency, whatever it is, NPCI in this case, it debits the buyer's account and tells the seller, look, money has been debited. At the same time, it actually sends the payment confirmation to the seller's bank. The money gets deposited into the seller's bank. The seller's bank confirms to the seller that money has been deposited. As you can see, there are so many steps involved where various people have to act. Suppose the bank is closed that day. The payment is taken and delivered to seller's bank. Bank is closed. Say typically in US, Thanksgiving or Independence Day may mean a 3-day holiday. That means that payment is held up for 3 days for various reasons. Any of these parties, if they are not available, if they take time, it gets held up. If they charge, all of them do have charges, it costs money. So, it costs both time and money in the regular process. How does it work with a credit card, with a blockchain? The experiment showed that the seller, the sender's bank, after the clearance is done, the process till delivery that cannot be compressed, the sender's bank, there is a blockchain, the clearing node is hosted in a blockchain. As we can see, all the transactions are written into the blockchain. The sender's bank, once the letter of contract fires, it sends a confirmation to the node, that seller confirms and the sender's bank confirms to the blockchain. It makes an entry in the blockchain saying that terms and conditions have been met. The clearing house immediately lets the receiver's bank know. It makes a transaction out of the blockchain covering the transferring the amount. That transaction also gets written into the blockchain. So, at any point everybody can see the transaction immediately getting reflected in the blockchain. Even if they are on the holiday, transaction will happen. The file is encrypted and stored. The receiver's bank not only gets confirmation, and it does not need confirmation from each individual party. The moment they make their entry into the blockchain, the sender's bank makes an entry saying that the transaction is approved. The clearing house makes an entry saying that money has been debited and credited. At each of these stakes, they just make an entry, they do not have to act anymore, and the other party, whether it is a receiver's bank, the clearing house or the sender's bank, can immediately see that the transaction happening. The smart contract written automatically, once terms are met, takes money from the corresponding account, deposits into the corresponding account. Even if they are closed, the transactions can still complete, and costs also are far reduced. So, this is a pilot experiment done by IDRBT to show the utility of blockchains in banking transactions. So, as I mentioned, lot of initiatives are happening to leverage blockchains in various aspects. One big aspect of it is the financial industry or the fintech industry, and this is an overview of the various efforts that is happening specifically in India. So, there is a lot of future, bright future, lot of applications, lot of opportunity for innovation in this field within India. This brings us to the end of the 7th lecture. Thank you.